A basic tenet in investing, and in my opinion, one of the most important, is that you cannot achieve returns without taking on risk. Balancing risk and investment returns is one of the most fundamental challenges of investing that anyone will face. So anytime you invest money into something, there's always a risk that you might not get it back. Investment returns should compensate you for the risk that you bear. So in theory, the higher the risk, the higher the potential return, and the lower the risk, the lower your expected return. This is why, I always emphasize an asset allocation, because I use, some sophisticated formulas that I'm able to, use projected and past returns and look at a person's portfolio and find out that many take more risk than they meant to, or they're not getting the return that they should with the risk that they are currently having. So they may be taking a lot of risk and getting mediocre returns instead of the higher returns that they should be getting. So it's very important that you look at your strategy and your portfolio, that you're not leaving money on the table or you're not unnecessarily taking too much risk. One of the ways we manage risk is by creating a foundation of investments like cash and highly rated bonds, mixed with more volatile investments like stocks and stock mutual funds. And this is what we call diversification and asset allocation, right? You're allocating the assets in a certain way. So to try and generate higher returns, we may even add a small amount of riskier investments, alternative investments. So you have a little bit of everything and you don't have all your eggs in one basket. If you had all your eggs in, let's say, Enron, right? Back, a decade ago, you would have lost everything. But let's just say you had only a couple percentage points in Enron, and then you had it in different other types of investments. Enron went belly up, you only lost a few percentage points, you'll recover. So that's what's very important about asset allocation and making sure that you limit your risk. So since no one can predict or control market movements, and that's one thing to note, nobody, right? That's why market timing, I believe, to me is a farce in the sense that people say that they can do it. Really, if that was the case, then 2008 would have happened. Nobody would have lost money if everyone could have timed the market. And a lot of smart money lost money. So that's why, if nobody can predict the market, what we have to do is that we need to generate returns while attempting to control the risks as much as possible. And this is kind of the idea that I call the investment pyramid and the asset allocation that I'll be showing you a little bit later. So, time horizon is another very important factor in developing an investment strategy, and it can be defined as the amount of time you have until you will need to withdraw your investment. So time horizon can range from seconds for a day trader all the way up to decades for a buy and hold investor. Now, there's no right time frame for everyone. Actually, the only right time frame is your time frame, right? It entirely depends on your personal goals, and it makes sense for a person who's investing for a retirement date 25 years away to choose different investment options than someone who's saving for a down payment for a house in 1 year, right? So everybody is in a different cycle of their financial life. And so based on where you're on that cycle, depends upon what type of investment objectives you want. So time horizon is closely related to risk because the shorter your time horizon, the less time you have to recover from short-term investment losses. So this means that generally speaking, the shorter your time frame, right, the more conservatively you should invest. Now this chart demonstrates this relationship, and it shows that the longer an investor's time horizon, the more risk he or she may be able to take on to see greater potential for return. So if you were 20 years from retirement, you lost a lot in the '08 crisis. Right now, as of 2014, right, about 6 years, 7 years since then, you made, if you kept it on, if you didn't sell, you made your money back plus some more. If you bought at that time at the lowest, you almost doubled, tripled your money depending on what you're invested in. So if you don't have that 6 to 7 years to recover, right, it pays to be more conservative. It's also important that that time horizon is only one factor that you consider when considering risk. And the longer the time horizon does not necessarily guarantee that an investment strategy will generate a high return. So all these principles are, are principles, but a lot of it depends on you. And so that's why it's very important that you are able to understand your personal needs. And we'll talk about that in another video. Okay, so let's asset allocation diversification, which I talked about. So asset allocation and diversification are one of the most powerful tools that you should use to seek returns while attempting to reduce investment risk. So asset allocation allows investors to spread their assets across multiple types of investments like stocks, bonds, cash, alternative investments that I talked about. And it can be by industry or sector. It can be by investment style. By investment style, I mean value, or it's going to be growth. Also by country, international. It could be Asia. It could be Europe, South America. It depends on kind of where you want to be. And so your asset allocation changes, though, over time as your investment goals, your time, and other factors change. That's why it's not one of those set and forget. I got a great asset allocation now. Doesn't mean you'll have the right one a year, 2 years from now, or even a quarter from now. So that's why you want to periodically come back to it. And for our gold and platinum members, I have at least a quarterly or a monthly update for your asset allocation plan, which is really cool. So diversifying a portfolio means reducing exposure to any single category, industry, country, or investment. So let's just say you were invested only in Asia and the 1997 financial crisis happened. You were in trouble. But let's just say you're in Asia, you're in Europe, you're in the US, you wouldn't have been hit as bad. That's an important reason to diversify. So the idea behind diversification is that a portfolio of different kinds of investments perform differently at any point in time, meaning that a decline affecting one investment may not affect your entire portfolio. So again, you're not having all your eggs in one basket. One may lose, but the other may win, so it offsets. So at any given time, you are limiting your losses, and if something gains, you're taking some of the gains with it. So that being said, it's important to note that diversification and asset allocation may not protect your portfolio from loss when markets as a whole decline, but in my opinion, it substantially reduces the risk that you'll lose more. Okay, so a little bit more about asset allocation diversification. I've shown this in my Art of Smart Money videos, is that how much of your gains are based upon different factors, right? So people may think, well, I should have bought here and sold at the high. Well, market timing only makes up close to 2%, less than 2% of a gain. It could be, well, I should have bought this stock, and then that would have been great. That's only about 4.6. Now, what if you say, well, I should have bought this stock at the right time? That only makes up, right, about 6 to 7%. That's about it. And if you include other factors, it's only about 9.5%, 91.5%. Way past the supermajority is your asset allocation policy. That is selecting suitable investments for you and the right amount of them, right? That's so important. And so the fact that a portfolio's long-term performance is determined so much by the distribution across the different asset classes, right? That is the percentage of investments in each class, means that you want to really take a look at it, that it matches what you want, and that you're continually, reevaluating if it is right for you, and that you are not, just setting and forgetting. Here's one example: the 2008 crisis. So let's just say that you were supposed to be in a 60 bond and 40 stock. And so 60% bonds, 40% stocks. So you're about to retire soon, within 5 to 10 years. So that's where you're at. And so what happens is that in 2005, 6, and 7, the market went up. So your percentage of stocks grew faster than bonds. So instead of becoming 60-40, the bonds and stocks, it flipped in 2008 to where you were at 60% stocks and at 40% bonds. Now, if you rebalanced every year, which is good, that means you're selling an asset class that's more expensive relative one that's more cheap. So one asset class is 12 goes up from, let's say, 10 to 12. The other one goes from 10 to 8, right? Because you have 20 to $20, let's just say, in that pot. And you sold off the $2 and you put it in the 8 to be at 10.10, right? That means you locked in the gains that you got from that one asset class, and then you bought it at a low, so when it goes up you can continue to go up. But a lot of people didn't rebalance and check their asset allocation. If a person kept the 60-40 and the 2008 crisis happened, they would have lost, let's just say, off the top of my head, maybe 20% of their portfolio. So let's just say 50% of stocks, you have 40% stocks, so you lose 20%. So you're down to $80 out of 100. But let's just say you didn't reevaluate your asset allocation and rebalance, and so you were at 60-40 the other way. In the 2008 crisis, using the same numbers, instead of losing $20, you would have lost $30 or 30%. So instead of having $80, you had $70. So that makes a significant difference. Now that $10, to make the $10 back, it's not a matter of just getting 10% up. It's actually, in some cases, doubling the percentage, right? So if you had $100 and you lost 50% of it, right? In math, it could be, oh, well, I just have to gain the 50% back. No, you have to gain 100% back. If you were $100 and you're down to $50 and you lost, 50% of it, if you had to gain $50, what's $50 out of $50? It's 100%, right? So that means when you lose, the gain has to be a lot more. So that's why it's so important that you keep your asset allocation plan. All right. Here's another important principle about accumulation versus distribution. So generally speaking, there are two basic phases in the lifetime of investing: accumulation and distribution. So during the accumulation phase, investors are working and hopefully contributing an increasing amount to their savings and investments each year as they approach their peak earning years. So the goal during this phase is to build up a portfolio that, when combined with Social Security, pensions, and other income sources, will give the investor a comfortable retirement lifestyle. During this phase, the impact of investment losses is smaller at the beginning, since there's less invested and more time to make up the losses. And the impact of losses increases, however, though, as the investor approaches retirement, which is why we generally counsel and I recommend more conservative investing strategies as you get closer to your retirement date. And, as we were all painfully aware through our experiences, investments don't always grow, which is why it's critical to match your investment strategy to your personal risk tolerance during the accumulation phase. This is what I mean. A lot of people before the 2008 crisis says, oh, you know what, I can handle risk, I'm good. The 2008 crisis happens and they really could not handle as much as they thought that they should have. And so I learned this, dealing with so many different clients, of really asking deeper questions than just asking, well, what's your risk? You can ask, and I do this as part of the data gathering, of doing different types of data gathering formulas to where I can get a better idea of your risk tolerance. And another thing too is women tend to be more risk averse than men. So when I deal with couples especially, I listen to both very, very closely. If one is more risk averse than the other, it's not a matter of just saying, well, you lose, you win. It's about, well, let's work together to where it could be win-win for both. And that's very important when it comes to, the accumulation and the retirement phase. All right, so due to the power of compound growth, the eighth wonder of the world that I've talked about, so regular contributions during the accumulation phase have more leverage than regular distributions have during the distribution phase. That is why it's so important to make consistent and increasing contributions to your retirement assets. So you may have regretted not putting money back in the past, but as I always said, the best time to invest may have been in the past, but the second best time is right now. So regardless of where you're at now, if you're not investing, you should start right now. The second phase of investing is the distribution phase, when the investor is taking money out of his or her portfolio to cover living expenses. So now you're retired, you're no longer working, so now you're living off of your investments. Now, if you're truly financially free, and that's part of my 4-step program, you may not actually be drawing down your investments. Your investments either may be staying the same or growing, because the interests from your investments are enough to cover your living expenses. And that's the goal, because you may want to leave the money for your children, for your beneficiaries, for charitable giving. So as opposed to just saying, well, I'm going to draw everything down, let's concentrate on building things up so you don't have to draw things down. So when you are withdrawing from your portfolio, the portfolio is still generating investment returns, but the gains are going to be reduced by the regular withdrawals that you will be making. So that's why the goal in this phase, the distribution phase, is to make sure your nest egg lasts as long as you need it to. All right, so here are the investment life stages. And there are 4 basic stages to an investor's life. There's the wealth accumulation phase, when investors are working and hopefully contributing an increasing amount to the savings and investment each year as they approach especially their peak earning years. Then the goal for this phase is to build up a portfolio that, when combined with your Social Security, pensions, other income sources, gives you financial freedom and the ability to live a comfortable retirement lifestyle. Now, due to the power of compound growth that we keep talking about, regular contributions during the accumulation phase have more leverage than regular distributions have during the distribution phase. I said that in the last slide. I want to say that again. Regular contributions during the accumulation phase have more leverage. That means they have more power. They're more important than regular distributions have during the distribution phase. This is why it's so important, right, that you continue to make consistent, increasing contributions to your retirement assets as much as possible. Then follows the wealth preservation stage, which is designed to protect what was built up during the first phase. And you preserve it through some good insurance products. You look at tax planning so Uncle Sam doesn't take away unnecessary taxes. And this is also capital preservation strategies. So the portfolio's ultimate size at retirement will depend on the size of investments, right? The return on those investments and the length of time before withdrawals begin. Not only do you want to preserve wealth, you also want to gain wealth. But at this stage, right, it's more important to preserve wealth than gain wealth because, again, like I said, how long do you have to make up for a loss? And you remember I said that if you lose $50, right, you need 100, you lose 50%, $50, you're not gaining just 50% to be back where you were. You have to gain 100%. That's why preserving is so much more important at times when you're getting close to retirement, because making the money back is going to take longer than just losing it, right? Now, third phase in investor's life is a distribution phase, when you are taking money out of your portfolio to cover your expenses. And while the portfolio is still generating returns, as I mentioned before, the gains are reduced by the regular withdrawal. So your gains are not going to be as much as they were in the other 2 phases. So the overall goal is you want your nest egg to last as long as you want and grow as much as possible, so that at the final phase, you have enough to transfer wealth to your children, loved ones, charitable causes. And while we'll talk about it later in for the members in future lessons that I'll have. But estate planning, wills, health directives is very important and something that every investor should start planning early on, because we may not know when we may pass and we need to make sure that our family is taken care of. Okay, so savings and investments. So, we use savings and investments interchangeably, right? Like they're the same thing. But it's important to note that actually there are some big differences. Savings are for emergencies and really are the foundation of a financial plan. Your savings should be kept in highly liquid accounts such as savings accounts, money market mutual funds, short-term CDs, so that you can access them quickly without having to sell out your investments to cover emergency expenses. I once had somebody who had no emergency savings but had a lot of money in their IRA. That was it. No emergency savings, no other investments, just a lot in IRA, and had to pull out the IRA. Not only did it take the 10% penalty because they were less than 59.5, also it had to pay taxes on the gains, right? And also you're not going to make that money back because you can't put that money back in. Once it's out, unless you take a loan against it, right? So that's why you want to make sure that you have a good emergency savings account. So the big thing about having the emergency savings, I always say about 3 to 6 months. That's a good way. It depends on industry. Some may not need as much. Some may even need more. So investments being different from savings are for long-term financial goals like buying a home, paying college, retirement. You want to take a trip years down the line for a big one that you want, your dream vacation. And this is simply because most securities are generally poorly suited for short-term gains, or could have short-term losses and may lose value. That's why investments, I always look at it as more volatile long-term, savings short-term, but more secure. Okay, emotional investing. This is, I've worked with thousands of people, and the number one enemy when it comes to investing are people themselves. Right? So the most successful long-term investors aren't the ones that make the best decisions, right? In the sense of picking stocks or timing or anything. They're the ones who make the best decisions when it comes to their emotions and are very, very disciplined. And one of the major mistakes many investors make is to give into emotional investing roller coaster. This is why the average investor, right, I think the past 20 years only got like 2.2%. But if you just stayed in the market, the S&P 500 was like 11%. So if you just stay in the market, you would have made 5 times as much as just doing what average investors do, because this is what happens. So you're confident, I'm making money, this is great, woohoo, euphoric. This is great, I made so much money, I should quit my day job, I'll do this full time, look at the money I'm making. When things are good, it's a riskiest time. Warren Buffett said, be fearful when others are greedy, and be greedy when others are fearful. Why? Because with every up, there's going to be a down. That's just the way the market goes. So euphoric, then it gets nervous. It's starting to go down. What's happened? What's going on here? Then all of a sudden, it goes downward. You're desperate. It's like, oh my goodness, there's no point selling now. I've lost too much. Then it goes down even further. You're defeated. There go my dreams of a comfortable retirement. A lot of people sell at this stage. But instead of being defeated, this is the best time to make money. Why? Because it's going to go back up again. Hopeful. Things seem around. Things seem like they're turning around for good. And this is going to go back and forth over and over and over again. Hopeful will then become confident, then become euphoric. So instead of buying at euphoria or confidence and selling at desperate, nervous, or defeated, reverse it. Buy it at defeated, hopeful, and then sell it at euphoric or confident. Those are what good investors can do. And that's why I really recommend that you work with a financial professionals, because they usually, and I'm one, but I mean, it's providing just kind of that voice of reassurance, taking the emotions out and saying, okay, let's look at this logically and being rational. So one of the ways that we use, strategies we use to get past emotional investing is called what we call dollar cost averaging. Continuing to buy. So that means you are buying when things are low, but you're also buying when things are high, in the sense where you're buying less shares when the price of the stock is expensive, and you're buying more shares when it's cheaper. So at the euphoria stage, a stock price may be $100. So if you had $100, right, you bought 1 share. But when it's at defeated, let's just say it's at $50. Guess what? You bought 2 shares. So that's why dollar cost averaging, paying yourself first, is a really good thing. And you know what? Because we can't predict with any certainty which way the markets will go. If you try to time the market, you'll get burned, right? And like I mentioned before, investors have been shown to be terrible predictors of market movements. And so if you're dollar cost averaging, it's a systematic approach. It also helps market fluctuations, in general, more people who do it, because it has less of an effect on the actual cost per share. If everyone's buying and selling, the price is going up. But if everyone's buying just regularly, regardless of what the price is, then the stock or the market tends to be a little less volatile, right? Now, it can't guarantee profits or protect you from losses, but it does help avoid the guesswork and stress when you're trying to time the market. And really, I do think that dollar cost averaging is a decent way. Again, this may not be best for everybody, because some people just say, you know what, I want to put the 10,000 now, because instead of just doing it over the next 10 months, $1,000, I want, again, time is the essence, so I want the compound interest now. You could lose it, but you can make it up. So again, it isn't for everybody. And in order to be successfully, lower your per share cost over time, you have to have the discipline and financial resources to be able to do it consistently and consistently invest over time. That's why I think, again, work with a financial principal to determine if it's an appropriate strategy and how much you should do. Okay, that I do want to talk about is spotting scams. It's an unfortunate reality that investing scams exist. And you know what? Even I, who I consider myself a professional that knows a lot and have worked with best, early on in my career, I also got scammed on certain things. Here are some common sense rules that can help you protect yourself and your assets, right? If people use high pressure sales techniques, they're pushing you, pushing you, pushing you, there's a good chance that it's a scam, right? Because if it's a really good product, it's a really good investment, they don't need to pressure you or they don't need to convince you, because as long as they just give you what it is, people will be smart enough to know they got it. If someone promises unusually high returns or guarantees against a loss, and again, I fell into this trap early on in my investing career where somebody said, hey, you're going to get 30% a year and I'm going to make sure you don't get anything because it's going to be collateralized with this. It turned out that it really wasn't true and it didn't pay out. Claim to use a proven or secret investing formula that no one else knows. This is Bernie Madoff. He, managed $65 billion or lost $65 billion. And he said he had the secret formula that nobody knew, but nobody could replicate it. And it was making money every year, even on down markets. So people are like, how's that possible? Well, guess what? It wasn't possible. So just be careful when you're spotting scams, especially for those that are elderly. And the reason for the elderly is that they tend to, some cases, are more desperate because they want to have that get-rich-quick scheme because they're near retirement, and some may not do as much research, and a lot of people take advantage of seniors, which is very unfortunate. My goal is to help arm anybody at any age so that that doesn't happen.